Stocks inching back towards all-time highs. Tallbacken's Michael Purves saying this: risk is on, volatility is low, with rate volatility retreating to pre-hiking cycle levels and, of course, very strong corporate earnings. Dips will continue to be bought, and to see 6,000 this year in the S&P is not as crazy as it sounds. Michael joins us now for more. Michael, I can tell you it sounds crazy, so tell us why it's not.
Well, look, we have this condition. I call it the dual Goldilocks. We have the Fed going from a very hawkish stance for from March 22 up through, effectively, when they got to terminal, and then it's kind of had stayed there. Now, they have kind of, very importantly, at the May meeting, they kind of walled off the hiking. Powell walled off the hiking concept. That's very important. That means the hawkish case for the near term is do nothing, and the dovish case is anything different than that, right? And then you have that combined with the dual Goldilocks is what I refer to as the concurrence of the worker consumer is doing pretty well right now, right? Employment, of course, is very tight. Real wages are not accelerating, but they are positive here, right? And they're, a little bit more disinflation over the summer. Against some wage gains. Your prior guest was talking about a lot of the nominal gains across union workers, and many others are kind of locked there. If you saw the ECI report from a couple of weeks ago, that was talking about some union workers getting 6 to 7% nominal gains there, right? So that's a pretty strong, powerful thing, and we've seen this reflected in earnings. If you look at the last season, out of the 11 sectors in the S&P 500, the main industry groups, every single sector had higher net operating margins than it did as from December, except for energy and healthcare, right? That's a pretty impressive thing. And a lot of these sector margins are at record highs, right? So companies have proven that they're very good at navigating inflation, some disinflation, very complex economic cycle here, and companies are really, you have to take your hats off to them.
I want to jump in and talk about next year. Lori Cavacina of RBC was with us earlier this morning, referenced her at the top of the hour. This is what she said: for a material move higher, we think investors will need to start looking and focusing on the outlook for 25, where visibility still seems a bit limited. What kind of visibility do you have on 25 to make these kind of calls?
Well, she's right. Look, I think, what are we going to learn between now and November? Not about either candidate and their policies, not too much more than we already know, which is really not that much. I think if you look at a Biden win, let's assume it's a gridlocked win, right? Maybe the Dems get the House and the Republicans get the Senate. That seems kind of consensus, best, sort of probable case right now. That scenario, I think, is pretty much more of the same, right? He's not going to be able to do anything massively. He's not going to be putting through a new IRA in that context there, right? And I think corporate CEOs are going to probably be like, okay, this is what we know. Earnings have grown pretty well under this condition over the last few years there. So I don't really look at that as an equity market negative. The harder one is the Trump win, right? There, because like you guys were discussing, there's a lot you just don't know. Who is he going to pick on his team? What are his policies going to be there? So look, certainly the textbook will tell you that, a Republican win, lower regulation, lower taxes, lower corporate taxes. That's going to be, net incrementally more bullish for equities. I would suggest this, though, John, that a Trump win probably, whatever asset prices do, they'll come with more volatility under Trump than under a gridlocked Biden.